Today we're looking into something interesting. Why do some financial pros and even whole organizations seem to really dislike annuities?
Yeah, it's a question you hear sometimes. We've got this document. Why are annuities so hated by professionals and organizations? And we want to sort of unpack the reasons it lays out.
Exactly.
hmm
Our goal isn't to argue for or against annuities here, but really just understand the thinking behind that negativity based on this source.
Let's get into it.
Okay, so the first big reason the document mentions is, well, it uses the word ignorance.
Right. And we should be clear, they mean it in the sense of just not knowing what you don't know. It applies to everyone, really.
Yeah, not necessarily a criticism or an observation. The idea is that maybe some advisors or firms, their understanding of annuities is sort of stuck in the past.
That's the core of it. The annuity world has actually changed quite a bit. Think about hybrid products, different fee structures.
Things that maybe weren't around when they first learned about annuities.
Exactly. If your training was, say, 15 years ago, you might have a very different picture in your head than what's available today.
The source even kind of throws down a challenge, suggesting a conversation could clear things up.
hmm A willingness to look at the current landscape.
Okay, that makes sense. Then point number two, conflict of interest. This one feels a bit more direct.
It is pretty straightforward, yeah. If an organization's whole investment philosophy is, say, purely based on market growth through stocks and bonds,
Then recommending an annuity, which often emphasizes guarantees or insurance components, just doesn't fit their model, does it?
it directly clashes. The document uses Fisher Investments as an example, pointing out their, historically strong anti-annuity stance.
Right. And the source suggests maybe that stance made sense way back when, based on older annuity types. But now,
Now it's kind of baked into their identity, maybe. Hard to change course, even if the products themselves have evolved significantly. It's like trying to turn a huge ship.
yeah, inertia. The source also mentions other conflicts, more practical ones.
Like,
Well, like maybe some advisors simply don't have access to sell a wide range of annuities through their firm.
right. Or the way they get paid, the fee structure might actually, discourage them from recommending an annuity because it pays them less than managing assets directly.
So it's not always about the client's best fit, potentially. It could be influenced by these structural things.
Those incentives are definitely real factors in the industry. It's something to be aware of.
Okay, the final reason the document brings up has a bit of swagger to it. The I can do better mentality.
Yes. The advisor who says, look, forget the annuity. I can get you better returns with my investment strategy.
But the source immediately pushes back on that, doesn't it?
It does. It focuses right in on a key annuity benefit, the potential for income for life,
Hmm.
guaranteed income.
And the question posed is pretty sharp. Can that advisor legally guarantee you'll get income for the rest of your life from their stock portfolio?
Well, no, they can project, they can manage risk, but a legal guarantee like an insurance company can offer, that's different.
A very different proposition. Now, the source does concede, fair enough, that purely for accumulation, just growing money.
Right. During certain market runs, maybe some investment portfolios could outperform certain annuities. That's possible.
But it shifts when you talk about guarantees and protection, especially in retirement income planning.
Totally. The source even uses this admittedly cherry-picked example, they say, of an annuity delivering like an 80% return over 2 years with no risk.
Just to make the point about the safety aspect being a key differentiator,
Yeah.
even if that specific return isn't typical.
Exactly. It's illustrating the potential for protection. And then they bring up long-term care annuities.
Yeah, that was interesting. The idea that you could put in, say, $100,000 and immediately have $300,000 available for long-term care needs.
And that benefit pool potentially growing maybe 3-5% a year if you don't use it right away.
The document basically asks who else offers that kind of specific guarantee.
It really highlights these unique insurance-based benefits that are hard, maybe impossible to replicate just through traditional investments.
So wrapping this up, the document suggests the negativity towards annuities often boils down to maybe three things: outdated knowledge,
Uh-huh. The ignorance,
conflicts of interest, whether philosophical or financial,
like structural issues.
and this belief among some pros that they can just get better results on their own, maybe overlooking the value of guarantees.
And it underlines that the annuity world isn't static. It changes. So perceptions might lag behind the reality of today's products.
Definitely food for thought. So for you listening, when you hear about annuities, maybe consider these angles. Could there be outdated info at play? Are there conflicts? What's the real trade-off between potential market growth and those sometimes unique guarantees? something to think about for your own situation. Thanks for diving deep with us.